Welcome to EION Weekly Gold Review.
Hello everyone, my name is Andy, bringing you EION Weekly Gold Review. The gold price rose by as much as 4.28% last week, from 1,889 to 1,970 an ounce. The surge in gold price was mainly due to the multinational sanctions against Russia and the prohibition of Russia's use of the transnational payment system, which is SWIFT, as the Russian invasion of Ukraine intensifies. The uncertainty over Russia's attack on Ukraine is sparking a massive shift to gold as a safe haven. During the Asian session on Monday, which is on the 28th of February, gold opened higher due to the Russian president's order to put Russian nuclear forces on high alert. Many countries have announced the closure of airspace to Russian flights, and Western allies have decided to prevent Russian banks from accessing the SWIFT payment system. European and American powers announced in a joint statement on Saturday that they would punish the Russian central bank and exclude some Russian banks from the SWIFT messaging system. The system is used in trillion-dollar transactions between banks around the world. This statement was issued by the US, the European Union, France, Germany, Italy, the United Kingdom, and Canada. The dollar rallied against nearly every other currency as the Russian currency tumbled to a record low on Monday after the West announced new sanctions to punish Russia for invading Ukraine, and Putin put its nuclear deterrent on high alert. Concerns about Russia's massive sale of its gold reserves will weigh heavily on the market going forward, especially if the Russian currency continues to plummet. In terms of the economic outlook, the ISM manufacturing PMI for February rose to 58.6, higher than the 58 estimated by analysts, an indication that the US manufacturing sector remains in a demand-driven, supply chain constrained environment. A reading above 50 indicates that manufacturing is expanding. The US Institute for Supply Management (ISM) said on Tuesday that the outlook for manufacturing over the next 2 months is good, with the largest increase in outstanding orders in 11 years last month. Factories also reported strong growth in orders. With inflation already running so hot and the Fed so far behind the curve, the escalation of the Russia-Ukraine crisis has pushed down the odds of interest rate hikes. Markets also see a minor chance of about 10% that the Fed won't hike rates at all. At his testimony, the Fed chair said he is inclined to support a 0.25% rate hike in March, quelling some concerns about the potential for a more aggressive rate hike. The US Labor Department's closely watched employment report showed payrolls added 678,000 jobs last month, beating expectations, and the unemployment rate fell to 3.8%, the lowest level since February 2020. The previous US non-farm payrolls report showed that wage growth slowed despite a surge in payrolls last month. Although the non-farm payrolls data was strong, the situation in Russia and Ukraine overshadowed the impacts of non-farm payrolls. The conclusion is that the market is still very wary of the situation in Russia and Ukraine. The situation in Russia and Ukraine has been negotiated twice. The two sides have agreed to temporarily stop fighting and evacuate civilians from Ukraine. The third negotiation is said to be carried out soon, and it is hoped that an agreement can be reached as soon as possible. This week, investors will continue to focus on the progress of the Russia-Ukraine crisis. In terms of economic data, investors need to pay attention to the inflation data, which is CPI, job vacancies, and consumer confidence index. With that, thank you for watching. I'm Andy from EION Management. Stay home, stay safe, and buy more gold. Think of gold, think of EION. Bye-bye.